Welcome to the deep dive. Today we're tackling some core financial stuff.
That's right. The balance sheet, income statement, and the statement of comprehensive income.
Yeah, exactly. We're using a financial reporting module to guide us. And really, the goal here is just to pull out what really matters in these
And make
statements.
them make sense. Show you how they reveal a company's financial health without getting lost in all the jargon.
Think of them like the dashboard of a car, maybe. Vital signs.
Vital signs. Yeah, I like that. We'll help you read those signs.
Okay, cool. Let's start with the balance sheet. It's called a snapshot. What's that about?
It's literally a picture at one specific moment in time. It shows what the company owns. Those are its assets.
Right.
What it owes to others, its liabilities.
Okay.
And then what's left over for the owners, which is stockholders' equity. It all has to balance out.
Classic equation. Assets minus liabilities equals equity.
Precisely. What you have minus what you owe is what you're worth, basically.
So assets, that's like cash, buildings, inventory.
Yep. And liabilities are things like accounts payable money owed to suppliers or loans, bonds payable.
Got it. And both get split up, right? Current versus non-current.
Exactly. Current means generally within a year, like cash you'll use soon or debts due soon. Non-current or long-term stretches out further, like property, equipment, or long-term debt.
And equity. That's the owner's stake.
Yeah, things like the original investment capital stock and profits the company has kept over time, that's retained earnings, and a few other bits we might touch on.
Okay, so that's the snapshot. What about the income statement then? If the balance sheet is still, this is.
This is the movie. It shows performance over a period like a quarter or a whole year.
Ah, okay.
It tracks the revenues coming in and the expenses that went out to earn those revenues. Ultimately, it tells you if the company made money, net income, or lost money.
We saw terms like single step and multiple step. Quick difference.
A single step is super simple, just total revenues and gains minus total expenses and losses. Boom, net income.
Easy enough.
Multiple step, though, breaks it down. It separates the main business, the operating stuff, from other things like interest or taxes.
Why do that?
Well, it lets you see important subtotals like gross profit, that's revenue minus the direct cost of the goods sold, and then income from operations gives you a much clearer view of how the core business itself is performing.
Right, before financing and taxes muddy the waters. Makes sense. And this idea of unexpired versus expired costs.
Think of prepaid rent. When you pay it, it's an unexpired cost, an asset, really. You haven't used the space yet.
Okay.
As each month passes, a portion of that cost expires. It becomes rent expense on the income statement because you've now received the benefit. You've used the space for that month.
Matches the cost to the benefit received.
Got it. Now, something that sounds important. Discontinued operations.
Yeah, that is significant. It's when a company gets rid of or plans to get rid of a whole segment of its business, and it represents a major strategic shift.
Like selling off a whole division. Exactly. If all sports companies sold its entire golf division, for example, the results of that division, its profits or losses leading up to the sale, plus any gain or loss on the sale itself, are pulled out.
Pulled out where?
They're shown separately on the income statement, down below the income from the parts of the business that are continuing. And it's shown net of tax.
So you can see how the ongoing business is doing on its own.
Precisely. And once it's marked as held for sale, they stop depreciating its assets and value it at either its book value or its estimated selling price minus selling costs, whichever is lower.
Interesting, Winkle. What about dealing internationally? Foreign currency transactions?
Ah, yes. If you buy or sell something and the payment is set in, say, euros or pesos, but your books are in dollars.
The exchange rate can change.
Right. Between when you make the deal and when you actually pay or get paid, the rate might fluctuate. That creates a foreign currency gain or loss.
Which hits the income statement.
Yeah.
If a Linto company bought goods priced in pesos and the peso gets stronger against the dollar before they pay, it costs them more dollars. That's a loss. If the peso weakens, it's gain.
Another layer of complexity. Okay, finally, the statement of comprehensive income. Net income isn't the whole story.
Not quite the whole story of equity changes from non-owners. Comprehensive income starts with net income and adds something called other comprehensive income, or OCI. These are specific types of gains and losses that bypass the regular income statement for various accounting reasons.
Like what? What goes in OCI?
Things like unrealized gains or losses on certain investments classified as available for sale, or adjustment from translating foreign subsidiary financials into the parent company's currency.
Mhm.
Also, certain hedging activities.
So stuff that affects the company's overall value, its equity, but isn't part of that main operating performance number.
Exactly. Net income plus OCI equals comprehensive income. It's the total change in equity from all non-owner sources during the period.
And where does this OCI stuff end up? It accumulates on the balance sheet in a separate section of equity called Accumulated Other Comprehensive Income, or AOCI.
Okay. And companies show this. How?
Two main ways. Either tack it onto the bottom of the regular income statement, making one big statement, or have a separate statement that starts with net income and then details the OCI items. You might see Sydney Technologies do it the second way, for instance. They also have to show the tax effects for each OCI bit.
Wow. Okay. So these three really are linked. Balance sheet position, income statement performance, comprehensive income adds that extra layer.
Absolutely. You need all three, really, to get a rounded picture. They tell the story together, what the company has, what it owes, and how well it's generating value.
It really drives home how these aren't just numbers. They're a language. The language business uses to tell its story. So the question for you listening is, now that you have a better feel for this language, what deeper questions does it spark about the companies you follow? What story are their financials telling you? That's something to chew on until our next deep dive.